Today, April 1st, it's a Wednesday, I got paid my first ever dividend. It was paid by Pepsi. It was for 88 cents or 96 cents if you're in the USA. And it got me thinking, just how important is this 88 cents? And more importantly, how much money will it make me in the future? Because I mean, who really cares about 88 cents? In my hand right now, I'm holding 90 cents. We don't produce 2 or 1 cent coins anymore, so I can't get 88, but you get the picture. I have 90 cents. What is the significance of this, and why am I so excited about this? Because if I walk to the shop with this right now, I'm going to get nothing that I want, man. I want to be able to get a drink for €1 or a snack. There's going to be very few things I could possibly get with this minuscule amount. So why am I so excited? So today we're going to be speaking about reinvesting your dividends and compound growth. And on the topic of compound growth, please smash the like button for me, subscribe and hit the bell button if you're new around here, and drop me a comment. Let me know what you think about this video so that the monkeys who work on the YouTube algorithm can push this video to more people. But anyway, let's get straight to the juicy stuff, as we like to do. So we all know that ultimately we invest our money in the stock market or real estate or wherever it is that you invest because we want our money to appreciate in value and to make us more money. Unless you're some sort of conspiracy theorist who keeps all his money under the bed because he doesn't believe in the banks, he thinks they're going to steal all his money. But when you invest, say I take this €20 and I want to invest it into a stock. If the man who owns that stock says to me, yeah, I'll take your €20, but I'm only going to give you €5 back, you're not going to invest there. That's not a very smart thing to do. You want your money to make money. Why would you accept this? But if instead you go to somebody and you say, I want to buy your stock, I want to give you €20 for a share in your company, and he says, that's okay, and in 10 years, I'm going to give you back €50. And in 20 years, I'm going to give you back a load of €50. That would sound like a much better investment. Your money is going to make you money as opposed to turning into a fiver that nobody wants. So as investors, we want to invest our money so that it appreciates in value and essentially makes us money for us doing absolutely zero, which is exactly what happened to me today. I woke up, I went onto my phone, I rolled over, I went onto the Trading 212 app as I do every single morning, and I saw, oh, Pepsi paid you an 88-cent dividend. So I got that for doing absolutely nothing. Yes, it is a very insignificant amount of change, but it was still for doing nothing. And this is why I like investing personally in dividend stocks predominantly, because even when the markets are doing really poorly, I'm still going to get some sort of money every month or 3 months by every single company that I invest in. They're going to pay me and I can either put that back into their company or into any other company in the world that I want. Now, where things get interesting. How can I use this little 88 cents that's in my hand to make me a lot more money in the future? Does it even matter if I just didn't reinvest that? Would it matter? Would I make much more money? That is what we're going to get into, and it may well surprise you a lot. So the first thing we're going to do is we're going to see how much return you would have seen on your investment in the S&P 500 over the last 40 years if you had have not reinvested your dividends against reinvesting your dividends on a monthly basis. So now we're on a website where we're going to be having a look at the S&P 500 Dividends Reinvested Price Calculator. And what we're going to do is, we're going to say our starting month was March 1980 and the ending month was March 2020. So 40 years in the difference, okay? And we are adjusted for inflation. So your total S&P 500 returns would have been 605% in the last 40 years, and your annualized S&P 500 returns would have been 5.005%, okay? Now, with dividends reinvested, our total S&P 500 returns would have been 1,861%, so over 3 times more just for reinvesting this 80 cents in every now and again. And your annualized S&P 500 return with dividends reinvested would have been a 7.725%, so over 2.5% more, again, just for reinvesting this little 88 cents. So this right here is why I'm so excited about my 88-cent dividend from Pepsi. Because that is the difference between 5% and nearly 8% is these dividends. If you just look at it as a one-off 88-cent payment, good luck, it's worth absolutely nothing. But if every single 3 months that you get that, you invest it back in, they're going to end up paying you more because more than likely they'll grow their dividend. You will get paid more because you've also invested more. It compounds very quickly forever. And just remember that those numbers were with inflation taken into account, so that's why they might seem a little bit lower than you expected. The average annualized total return for the S&P 500 index over the past 90 years is actually 9.8%, which is far above what we just saw. But again, keep in mind, we're accounting for inflation. So now we're on an investment calculator website, right? And let's just say you want to get to investing. How long will it take you to get to $1 million? Okay, your starting amount, boom, zero. You start with absolutely nothing. In 36 years, at that return rate of 9.8%, with a contribution of $280 a month, which is less than $10 a day, you would be seeing an end balance of over $1 million, and you would have invested 120,960 of those dollars. This is why dividends and compound interest are so important. You could have just been putting that money into the bank and you will essentially have that much money. Would you rather that much money or $1 million? you choose. You put away not even $10 a day every day for 36 years, and you could be looking historically at an average of $1 million. Seems like a pretty good deal to me, man. So that would mean for me, I'd be 58 years old and I'd have $1 million. But I plan on putting away a whole lot more than $10 a day. Let's just say you can put away $50 a day. Let's see what that leaves us with. Boom. 5 million. But yeah, I assume you now get the picture and you can straight away just off of that see how powerful compound interest is. And me personally, my average dividend yield from the companies I'm invested in is about 3.5% to 4%. Some of them are as low as 1.5%. Some of them are as high as 7+%, but it averages out somewhere around 3.5% to 4%. So everything I invest, I will get back about that much money every single year to then reinvest. Through dividends alone, you will make back more money than you would have made in interest in most savings accounts, credit unions, banks, anything along those lines, just through dividends alone, not even accounting for the stock growth that is expected in the long term. Now, the stocks that I primarily invest in are really safe stocks that have been around for a long time. The Coca-Colas, the Pepsis, the Johnson & Johnsons, the Procter Gambles, the 3Ms, all of those kind of stocks that have a history of many years, a lot of them 50+ years of paying and increasing their dividend. That is the companies that I personally like to invest the majority of my money in. Now, I do have some that aren't quite as safe, that have more growth potential, like Delta, a company I recently opened a position in, and two others that I'm looking at, Carnival Cruise Corp, which I made a full video on, and Tesla, which I also made a full video on. But the large majority of my money is in these very safe, relatively nice dividend paying companies. So a company does not have to pay you their dividend, and they can cut it at any time they want. That's why it's important to invest in the bigger ones that have been paying dividends for 25, 50+ years. They are ones who are a lot safer. They're ones who are a lot more likely to keep paying their dividend when times get tough, like what's happening right now. I'm just going to show you two very different stocks who pay dividends, both of which I am invested in, just so that you can see that not all of them are created equal. So we're looking at Procter Gamble company, one that everybody knows about. They have a dividend safety of 99 and a current dividend yield of 2.7%. They've paid and increased their dividends for over 62 years. It didn't matter when the Great Recession came, anything like that. They were still paying dividends, and they even increased them in those really tough times. So this is a company who's rated extremely safely and has been paying dividends for over 60+ years and has proven that they can get through tough times. Now let's have a look at Delta. Now, Delta is a company who up until now have paid their dividend and increased their dividend relatively nicely over the last 9 years. But boom, news headline, Boeing and Delta Airlines suspend dividends. So they will not be paying me for my investment until times get a little bit better. And that's understandable. We know why, is because they're struggling so hard right now. Again, I have a full video on Delta if they do pique your interest. But I saw this coming in advance. Yeah, let's just have a look at their dividend growth. So you see they had to cut it again when times got tough, and then when they brought it back, it boomed up. So that is one reason I'm not too worried about not getting a dividend for the next year, maybe 2 years, 3 years. Who knows? We could have it back in 6 months. But it's because when it does come back, I would expect it to grow very rapidly and very quickly, and I also expect the share as a whole to grow very rapidly and quickly. But this is an example of a company that's a little bit riskier, and I have lost their dividend, and I bought them expecting to lose the dividend, but it's just because of the growth potential. It's just important to know that when you're buying your stocks, not all of them are created equal by any means whatsoever. So I think over the next week or two, a lot of companies are going to either suspend or lower their dividend just because of the economic times that we're in right now. So that's definitely something to keep in mind when you are looking and evaluating the companies that you want to buy as a dividend investor. But again, there are certain companies out there who will almost certainly not cut their dividend just because times get tough. You just have to do the research. I do hope that you enjoyed that video, guys. Market is about to open in literally 5 minutes, so I need to go figure out where I want to put my 88 cents so we can turn into millions in the years to come. Not millions, but you get the picture. If you did enjoy, please do drop the video a like. It helps me out massively. Subscribe if you aren't yet. Drop me a comment with your thoughts or opinions on the video. And until the next one, guys, peace.